So it's my pleasure to introduce Gary Mishuris, who's our guest speaker for today. Gary, as I mentioned, is the founding partner and chief investment officer for Silverring Value Partners. He started his career as an equity analyst at Fidelity before going on to hold portfolio management roles at both Evergreen and Manulife, and then he started his own fund in 2016. Gary also hosts an 11-week seminar series on value investing for us here at Babson, which will start tomorrow. And so at the end of the presentation, I can give you some additional information, but if that's a program that you're interested in, the deadline for the applications is today at 5. So you've got a limited window.
4.
4. Today at 4.
Tight squeeze.
So with that,
Grateful. Thank you, Patrick.
thank you.
Appreciate it. Thank you guys for your time. Appreciate it. So I'm going to talk today about how to approach learning about value investing. And I think some of you might know what value investing is, some might not. So I'll just kind of go through it and leave plenty of time for Q&A. So I'll skip the background. I think Patrick did an excellent job about Silverring. But if you were to think about investing, right, the first way it breaks down is passive versus active. So the first thing you kind of can do is to say, okay, I'm just going to get an average return. I don't want to beat the market. And by the way, you would do better than most people, if you did that. I think the index beats like 80% of active managers. So it's not at all a terrible approach. As a matter of fact, when many friends might ask me, I think for most people, it's actually probably a pretty good starting point. And we actually I don't know if a moment of silence is appropriate, but John Bogle, who started passive investing, just passed away last week. So he was probably the person who I would say did the most for investors. So it's not guys like me. It's someone like him who basically got people to save a lot of money and have a simple, low-cost approach. So hats off to him. But let's say you want to pursue an active approach. And that active approach assumes that there are securities, stocks, bonds, and so forth, that are inefficiently priced, right? So that the price is wrong, but not only that the price is wrong, but that you can figure out that it's wrong in advance. Because after the fact is not very interesting. It's kind of like Monday morning quarterbacking. So active investing, in turn, breaks down to 2 broad categories. That's obviously my very kind of self-centered distinction, but I think it is the right way to think about it, which is intrinsic value, which is, so you have, I usually use some props, so let's see if I can grab something here. Well, it's attached. But you have something that's worth 100 cents, right? You think you did the work and you think it's worth about 100 cents. We can never be sure. So it's not like for a fact it's worth, but you think maybe it's 80, maybe it's 120. You think it's about 100, and you're trying to figure out what the business is worth, and then you're trying to buy it with a big margin of safety, and that's the discount to intrinsic value. So you're thinking about the business. You're not thinking about the piece of paper that trades. You're not trying to guess what Jim Cramer is going to say on CNBC and where the stock is going to go, or if there's going to be an earnings surprise, or if Goldman Sachs is going to upgrade it, or you're putting that aside for a second. And you're thinking, what's the business worth? How would I act if there were no stock market? So essentially, almost a private equity approach to the public markets. And then there's everything else. And everything else could be technical analysis, where you're looking for head and shoulders patterns, or it could be looking for momentum, meaning or companies that beat earnings. There are all these approaches there. They're really oriented around thinking about what other market participants will do, like treating it as a game. So it's a game like, okay, if I buy this piece of paper today, someone will pay me more tomorrow. So those are the 2 big kind of intellectual camps. So investing actually is pretty hard. And it's funny, I started investing in 2001. So I graduated from MIT and I went straight into Fidelity. And I was very eager. I read a bunch of value investing stuff. I thought this is going to be easy. I passed my level 1 of the CFA. I was excited. It's going to be a piece of cake. And it's actually, the funny thing is now 18 years later, I think it's harder than I thought it was then. And the reason isn't because I got worse. I hope, possible, I guess. But it's really because I didn't realize how hard it was. Like how easy it is to be overconfident, how easy it is to just have the hubris to think you know what you're doing and really not know what you're doing. By the way, I actually suspect, and that a lot of people who are quite senior who think they know what they're doing actually don't. Because they have the appearances, they have a fancy, they look good on CNBC, but they don't actually have the process they're executing and the tendencies that the behavior that's going to get them the right place. So it's not just people who are starting out. I think it's a lot of people. So what makes investing hard? So there's a long feedback loop between decisions and knowing an outcome. So it's hard to learn when there's a long feedback loop. Like there's no one telling you, Patrick might tell you got this question right, and you can learn for the next. It's a long cycle. There are behavioral biases. So overconfidence is one. There are a ton of them, but we can go through them. I think that the temperament is something that people really underestimate. So by temperament, I mean, let's say you know perfectly well what you need to do, but can you actually do it? So can you do it in the heat of the moment when there's a lot of pressure, when there's a lot on the line, or you perceive that there's a lot on the line? And then I think really the best practitioners combine and think of this as an art and a science. So there is definitely a science part, but there's also a quality of judgment that you can't, I believe, replace with a computer or something like that. So we'll talk about each of these in turn. So the long feedback loop, I always like to talk about this. If you think about how to hammer in nails, right? You take a nail and you hit. And if you miss, how you know your finger really hurts. That's just pretty straightforward. So the feedback loop is short, and you're going to figure out, you're going to adjust how you hit, or you're going to have missing finger, or you're going to hire someone else to do it. You're going to, but you're going to know very quickly if you're doing this right. On the other hand, again, there's this long feedback loop, and if my investments professor at Sloan was Ken French of the Fama French fame, and he did on the board for us in the investments class, how long would it take for a track record to be statistically significant? And what he meant by that, how can we be 90% sure that it's skill and not luck, or that your record is different from the market's record? And it takes 10 plus years. So it's not optimal to say, okay, I'm going to do whatever I think is best now for 10 years, see how I do, and do it another, and because you just need to adjust faster. How many 10-year periods do you have in your career? 3, 4, 5, 10? I don't know. People live a long time. So the problem is you have this long feedback loop, and in the long term, the value of a business is really just the net present value of cash flows and any excess assets that are not used to generate those cash flows. That's pretty simple. In the short term, there's all this noise that moves stocks around. So you can be exactly right, but you can buy a stock for 50 cents that is worth $1, and turns out that someone else thinks it should be worth 30 cents, and it goes to 30 cents and stays there for a year or two. And so what do you learn from that? Do you learn that you were wrong? Maybe, but maybe you weren't wrong. You were right. Maybe you just got unlucky and there was some event that was out of your control or something like that. So you have to, it's hard to figure out skill versus luck, especially in the short term. So trial and error is not the way to go. Behavioral biases, I mentioned a few. Overconfidence is one. So perhaps I'm overconfident I can beat the market. I hope not, but I'm aware that that's actually a possibility, right? We can all, we all think that everyone else is overconfident, but we're not, and that's actually an example of being overconfident. Base rate neglect. It's basically, thinking about things like, okay, what's been the average experience of people doing this in the past? So if you have an urn with, 60 Red Bulls and 40 Black Bulls, in the past, people, have a 60% chance of, randomly picking out a Red Bull. Pretty obvious. If you come up and say, I'm going to randomly reach in there and I'm going to get a Red Bull, 90% of the time, you're ignoring the fact that the distribution that you're drawing is set up a certain way, and you're ignoring that base rate. Anchoring is another. Basically, you start with a decision. You say, well, I don't want, Gary is speaking, and I don't want to learn value investing. You anchor on that. No matter what Gary says, you don't change your mind. So that's an anchor. Hopefully, no one has that, right? You have recency bias. So all the time in Wall Street, we see people take the last few quarters or a year or two of results and assume that's going to keep going. No matter if it's bad, it's going to keep staying bad. If it's good, it's going to stay good. And that's partly what causes mispricings, is people not thinking about the value. But as my mentor, Fidelity, Joel Tillinghast, who I think Patrick had last semester, he likes to say people like to think about what happens next. So they're not asking what's the business worth. They're asking what comes next. Are they going to beat the quarter? They beat the quarter the last 3 quarters. They're going to beat the next quarter. They're not thinking, what's the business worth? Is it more or less than the price, and so forth? So it's actually hard to make good decisions. We have all these mechanisms in our head that make it difficult. I don't think, by the way, you can eliminate behavioral biases. So I think perfection is not attainable. But being aware of them and having systems in place, a checklist, things like that, can help you minimize them. And by the way, this is applicable everywhere. We're all biased, except for me. So temperament. So basically, I'm almost gonna. I never read slides, but I'm gonna do it here. So you have, this Buffett quote. Temperament is more important than IQ. You need reasonable intelligence, but you absolutely have to have the right temperament. And I think that's key. And by temperament, by the way, it's can you keep even keel? If you buy a stock and you think it's worth 100, You buy it for 50 and it goes to 30. Like, what do you do? Like, without naming any names, I have a very smart friend. I'm not even going to give any more identifying details. He's an extremely good analyst, very experienced. And I get texts from him, like, what do I do now? Like, I cannot show you these texts, quote, because you'll think it's a much younger person, say, like literally, crying uncle, like, my stock went down. It's like, well, you did the work, right? But it's down. It's down 50%. What do I do? My performance is such and such. What's my boss going to say? So it's hard to, he knows what to do. His problem isn't not knowing what the business is worth. His problem is keeping an even keel and just following through. It's hard. For some, it's not as hard. For Buffett, it's not very hard. For others, so if you're wired the wrong way, unfortunately, my belief, and some disagree, is you can get somewhat better, but the temperament is one of those things I do think that it's hard to change meaningfully. Yogi Berra, well, who knows who said, but in theory, there's no difference in theory and practice, but in practice, there is. You can be very, there are people who, write great papers on strategy, competitive advantage, but, Michael Porter is a very smart man. He's not the world's best investor. How come? Because it's not just knowing all the theory, it's actually knowing theory well enough and applying it that gets you the results. Otherwise, the theoreticians would have Warren Buffett's net worth and Warren Buffett, would have theirs, right? And then there's Mike Tyson quote, which probably summarizes it pretty well, is everyone has a plan until they get punched in the face. And I think that's kind of true of investing. Like when I started at Fidelity, I was a cocky young analyst, and I covered small cap, especially chemical stocks. And I basically started, and I remember we owned 15% of my recommendation of this company. It's 150 million that Fidelity owned, which for Fidelity was nothing, but for me felt like a lot of responsibility as a 21-year-old. And I remember how I constantly told all these PMs, don't worry, and it's fine, focus on intrinsic value. And the stock kept going down, and and one PM says, let's do a call with the company. And from the call, it was pretty clear that they weren't doing as well as people thought. But I'm like, we need to not focus on the short term, let's focus on the long term. Things I still believed. All right. And then right before Christmas, the day before Christmas Eve, they pre-announced results. But it's not like one of those, things are a little bad. The dividend disappears. Poof, and the result's going to be 50% worse than expected. So the stock literally it opens up 50% down. I felt like throwing up, viscerally. Like it's, I knew what the right thing to do is. The right thing was to visit all the portfolio managers who own the stock, communicate my best assessment. And I remember at that time, one portfolio manager who was a big Warren Buffett fan said, go home and rethink how you're picking stocks. Think about what. And I finished my rounds and I went home. I didn't throw up, but I was close. So it's really, it sounds like, well, why does it matter so much? If you really care, and if it's high stakes, whether it's other people's money involved, you have a lot of responsibility, whether it's clients or your own family, whatever it is. It's not the same as putting $1,000 into an E-Trade account, because you guys are all bright, right? Your future net worth is going to be many hundreds of thousands of dollars probably. So even though $1,000 might be all your spare cash, and maybe you lose it all, that sucks, is the technical term, but you're not gonna have the same, oh my gosh, moment as if 150 million just went to 75. Especially, it's hard to have the perspective. It's your first big recommendation, right? So that, can you react? Can you keep cool? Can you redo the analysis? Update. What do we do next that's rational? Or are you under your desk crying? I wanted to. I didn't, but I really wanted to. So investing is both an art and a science. So, the science part is maybe financial modeling, collecting data. That's pretty straightforward. I kind of joke like a monkey could do it, maybe not. But you pretty much could, anyone could do the science part. It's formulaic. The art part is things like, are these honest people managing the company? Are they trying to get rich off of you, or are they trying to create wealth and, share it equitably? Is it a good business? Like, what is a good business? And why does it matter? And not even better, how good of a business, because business aren't good or bad, just like people aren't good or bad. It's a more nuanced decision. So these judgments, they're not reducible to a formula. You can have process, so you can have a situation where you have a way of systematically addressing those questions. But at the end of the day, there's not an equation you solve and say, yep, that person is honest. It's a combination, it's weighing various incomplete information. So you need both, science and art. And the best way is deliberate practice. So there is this common statistic out there that to become an expert in something, say chess master, you need 10,000 hours of practice. And I think the corollary, and they've corrected this, is people sometimes think, well, I keep playing chess for 10,000 hours, I'm going to become a chess master. Trust me. I played chess in high school. It's not how it works. It's deliberate practice. So think about chess as a good example, because chess is a pure science, right? It's purely analytical. There's no, there's psychology of how, like in any sport competition, like bring your best mental state to the competition. But beyond that, it's just, hard, cut and dry. You get feedback from a master player. So you don't just keep playing, you play, or maybe you study someone else's game, or you study your own game, and then you review it with a stronger player who gives you process feedback. Like, could you have done differently? Have you considered this other move? And so I think that's deliberate practice, and that's how you become a chess master or an expert, or in sport. It's not just playing recreational soccer or recreational basketball. It's, even if you play with good people, you'll get in plateau to some point. You're not going to, become an Olympic athlete if you just play pickup basketball, nonstop. It's training, but it's also deliberate, having someone who's going to teach you the techniques, and then also tell you specifically, not a generalized, like what could you be doing differently. Learning, how to be a good investor. I think you have to start with the right temperament. So again, if you are gonna every time go and cry under the desk when something goes wrong, it's just not for you. But it's, I think most people can get beyond that phase. And that's kind of like a, mostly a joke. But there is the not. People do irrational things. People do things that you could not possibly explain to someone else. Like, why did you do that? And the answer is they were off kilter. They weren't being rational. So study investing theory. There is no substitute. Just because it's not sufficient, it's still necessary. You can't. Again, it's not about just you're just going to invest and There's the old joke that there is 20 years experience and there's 1 year's experience 20 times. If you don't study theory and understand the framework for what you should be doing, you're not going to learn very well. And I think you should really study what worked for other people. So because it's an art and a science, you don't really want to just study theory, nor do you want to just do trial and error. You want to see, okay, what are successful people who've had a kind of consistent framework, who had an idea for a philosophy and a process. How did they achieve a great record over long term? And it would be awesome if they came over and taught you, but some of them are dead. Actually, some of the best ones probably have passed away, like a Benjamin Graham. That doesn't mean you can't learn from them. And I think that I highly advise that, and that's what this seminar is about. Many years of deliberate practice with feedback, really important. You're not going to get, it's not a, it's a contact sport, even though it's not a sport and there's no actual contact. You need to actually do it and get feedback. And then I think read. Buffett is famous for saying that he doesn't know any good investor or any really thoughtful person who doesn't read a lot. So you have to read a lot, but it's not like comic books. You have to pick the right things to read. Although comic books are fine for entertainment. And finally, I think Charlie Munger is a big fan of mental models from other disciplines. So it's taking things from psychology, from physics, from other things and applying them to another discipline. So if you are just kind of like the equivalent of cross-training in sports, you don't want to just, yes, you want to be really good at the thing you're doing, but then you want to broaden your mind and think about, like, well, what have they figured out somewhere else that's applicable here? And that's what I mean by mental models. So that brings me to the value investing reading course. So basically the idea is, this started a while back. I was 3 years at Fidelity. I just started Evergreen Investments, and an analyst came to me and he was about to present the next day. And he respected me and he said, can you proofread this and give me some feedback? I'm presenting tomorrow. There's some company. It's his first big presentation. He was an operations person who got promoted to the investment team. And I read it, and I said, how do I tell him this is awful? Like, that's probably not useful feedback. Like, hey, dude, it's awful. Go. So and I'm like, he's presenting tomorrow, so is he going to change it? Should I just tell him it's awesome to build his confidence? So And I said, look, I don't know how to tell you, but there's substantial changes that you could make if you had time. So I was trying to be diplomatic, and he kind of got the memo, and he rescheduled the presentation. But then he came back and said, well, no one really taught me. Like, how do I learn? I was in operations. I was, investment firms operations is not the favorite place to be. People, not everyone. Look, operations are important, but typically people, want to, who are interested in investing don't want to work in operations. They want to work in equity research or portfolio management and so forth. So he said, how do I learn? And I was 3 years at Fidelity, and I've been humbled plenty of times. I said, look, I'm not qualified to teach you. It's not, I'm not some grizzled veteran, but why don't we, read some books together that I found helpful? And so that's kind of how the value investing reading course has started. I start with Benjamin Graham security analysis, and then Phil Fisher, and then Buffett. And that's probably what we're going to cover, because I think in 11 weeks, that's a good amount to cover. Because we're not just reading and we're reading purposefully. We're studying deliberately. We're thinking about, we're using examples to illustrate the points. And you would be shocked how many senior portfolio managers, if you would do a survey, never read security analysis, not once. Huge mistake. And it shows in the results, I think, because you can totally invest differently from Ben Graham. The point, by the way, is not to replicate these guys. The point is to understand why they did it, and then think about your own strengths and weaknesses, and basically then decide how do you build your own investment framework, but learning from what's worked and learning from what's already out there, because you don't want to reinvent the wheel, but you also don't want to just blindly replicate someone. Because you might, like I'm very analytical. I went to MIT, I'm an engineer by training. I like that, very rigorous step-by-step steps. Other people are much more qualitative. That's not wrong. You just need to understand that if you're that way, you don't want to force yourself to be someone you're not. But you also need to be effective. So you need to figure out how do I become effective and play to my strengths and minimize my weaknesses. And that's always true in life, but it's true in investing. So that's the value investing reading course. The point is to read together. There'll be questions and then discuss. And there's no right or wrong answer. There are no trick questions. It's not. I don't grade because what's the point? Like life will grade everyone, right? The point is to help people. What I can do is bring a practitioner's perspective of someone who has done this for 18 years and give feedback. But there'll be a lot of times I'll tell you I'm not sure, or let's figure it out together. So I think that I learned. I've used this for a number of my interns. I use it now with some interns that I'm working with now. I use it with junior colleagues, and I kind of developed this over the prior 13, 14 years. And I wanted to share with you guys because, frankly, a lot of people have spent time with me and mentored me when I really didn't know what I was doing, and I didn't know that I didn't know what I was doing. And a number of them invested time in a way that, honestly, they didn't need to do. So part of it is I enjoy teaching, and part of it is I want to pay it forward, or whatever the right phrase is. So with that, my contact information is there. I think, as Patrick mentioned, applications are due 4. Clock is ticking. If we were really promotional, there would be a countdown and only 2 spots left or something like that. But we're not going to do that. We don't charge for the course. So let me take questions. Otherwise, thank you. If there are no questions, it'll be a really quick meeting. I'll go back and next step. But I'm happy to answer anything and everything. And I'm not going to pick on anyone. Otherwise, I'm going to have Farah volunteer. Oh, there we go. We got a first opener. I like it.
So first, I just want to thank you again for the presentation.
Of course.
When you started Silver Ring,
Mm-hmm.
What was your thought process in getting together a team? What were you looking for in your other teammates for the quality of investments that they would make? How did you evaluate that?
So, it's not the answer you expect. I don't really have a team. It's me, and I use interns and part-time work. And I might have 1 or 2 junior people in the future. And I thought about this a lot. So it's funny, I came from Fidelity. And you would think, if the biggest team were the biggest advantage, the biggest firm should have the best record. And, I will not, I'll let you look it up. But I think from the way I'm thinking, you might suspect that might not be the case on average. So if it's not scale and team, what is it? I think the problem with teams is that you don't want to delegate decision-making to where someone is not yet ready to do it. But yet, to create a career progression for the person, you almost have to. So last place I worked, Malifest Management, I love the people. We had a really good team. And a number of them, the chief investment officer is an investor in the partnership, as a number of other people on the team. So good, nothing but good things to say. Good analysts. The problem is, there were 2 or 3 years of the business school. Now all of a sudden they're making decisions about investing. It reminds me of me when I didn't know. And you don't want to tell someone, look, you don't want to be like, hey, you don't know what you're doing because you're too inexperienced. But the truth is, their best value add is helping with different steps. So think of it as an apprenticeship. If so I'm into bonsai. I'm a beginner, but I try to learn from other practitioners. But the way in Japan, it's there's a master, bonsai artist, and then there the apprentices that do more manual tasks. But in the process, the master teaches them, and then they go on and become their own master, and that's the process. But if the way this is almost equivalent of having a bonsai MBA and someone coming from 2 years of practice, and they come and say, hey, I'm ready to make my own tree. The master, move aside, give me 10% of your trees, I will make the trees for you. You know, investors are like, what do you mean? Like, you know, you don't know how all these techniques yet. You haven't done it in practice enough. So it becomes hard because people's egos, I think, force them to want more responsibility, which is good, which is like you have driven, smart, ambitious people. But at the same time, you don't want to hold them back. And then what happens is behavioral biases sneak in. Like someone comes to you and says, buy stock XYZ. And you say, no, because of these reasons. They come again, buy stock ABC. Give them another sentence. Then the third time they come to you, and you still think it's not a good investment, like you feel badly because like you're kind of making this person feel like they're not valued, that they're not having impact. So maybe you buy a little bit. So now there are definitely a trade-off. So I think the way I think about it is, I think about investing tasks as 1 through 10. Like 10 might be the highest level of improving your own investment philosophy, or really high-level thinking tasks, and 1 is like data gathering, and then there's stuff in between, right? So I think that you want this person who is the best investor doing the high-level tasks, and then you want people who are learning doing the lower-level tasks. But in reality, what happens is the higher-level tasks get delegated, and I know from Fidelity, like I came from MIT, no experience, and I was recommending stocks, right? Like, so they gave me 6 months, said you have all the resources in the world, you should recommend, look at specialty chemicals, come back to us with what should we buy. I think that's insane. Like, I really do. Because, like, what does Gary at 21, like, know about, especially, like, yes, he can call all the CEOs and they'll take his call because it's Fidelity. But so anyway, long-winded answer is, my plan is to work with people who want a kind of an apprenticeship model. They don't mind doing the kind of lower-level tasks in exchange for mentoring. So it's not kind of a, kind of slave labor. It's, hey, you will get trained, you will get mentorship, but in exchange, yeah, I need you to do these tasks that are maybe 1 through 3 or 1 through 4, so I can spend more of my time on 5 through 10. Does that answer your question?
No, yeah.
And I think the qualities. I look for passion for value investing. Yeah, that's number 1, and you can't fake it. I have easy set of questions I can tell. Like I ask people, what books have you read on your own? And then once they tell me, what have you learned? I had a guy in my office, experienced guy, he looked right past my shoulder and started telling me the books he read from my shelf. I said, okay, that's true. And I knew he was lying, so we just had some fun. Great, so I picked it up, like, so what did you learn from that book? He's like, So now he revealed that he's dishonest and he's not passionate. So, we spent the next 20 minutes just chatting because he obviously wasn't getting the job. But so that brings me to the other point is, like, I think intellectual honesty and just honesty in general. Because you can teach someone technical skills, but you can't, and integrity, and I don't know how to test for integrity. I used to joke, like, do you leave a $20 bill and go to the bathroom and see if they, take it, or that's too obvious. But I think integrity is super important because you can't monitor everyone 100% of the time, right? So you can't say, I'm going to supervise you so close I see everything you do. Like, and I knew I was friends with a lot of analysts on the team, and my old boss, one of my other firms, was trying to change the philosophy. And there were a bunch of old guard people who were resisting. They were like conventional analysts, and he was changing it to an intrinsic value philosophy. And there were all these older people who were basically making up numbers inside the model. Hopefully he wouldn't catch it, just to fake it to get the answer they wanted in the new. Like, it's hard to check that. Like, so so I think like I just couldn't do it. Like, I would butt heads with a guy on some things, and even though it was unpleasant, he was a strong-willed individual, which I respect. But but I just couldn't bring myself. Like, I'm not going to lie, but I'm going to put whatever I think is best, and then we'll talk about it. And if I'm wrong, if he wants to overrule me, that's fine. But a lot of people kind of just said, yes, sir, but then they did something that the guy didn't know they were doing. And I thought that, I honestly thought those guys should have been fired. I didn't say anything because, they were kind of telling me this in confidence, but I probably should have. Probably should have said, I definitely told them, you shouldn't do this, but probably should have brought them and said, hey, this is not the behavior we want. So I think honesty and intellectual honesty and basic passion, because you can't teach passion. Other questions? Yeah?
When you talked about temperament, I was wondering I was curious of how much you go about having a better temperament, because the industry revolves around people parading their successes when they're profitable. So how is it possible to handle failure or a bumpy road better? Like, I don't want to be the person under my desk crying.
Right.
So if you could just talk.
There might not be much room there.
Yeah,
other people will be already.
Definitely. Because I have a feeling that temperament is not something that you can wake up one day and just have a different one. So if you could describe the process of a better temperament.
I mean, I think it's interesting. So there is this idea of static mindset versus dynamic mindset in psychology, right? And so we've been taught to encourage ourselves and others to have a dynamic mindset. And what I mean by that is that we can change. So this is going to go a little bit against that. So one of my friends is a director of research at MFS, and we debate this all the time. So he thinks you can teach temperament. I disagree. I think you have kind of your natural starting point, and you can move a little bit in each direction. But I think beyond that, I forget which famous basketball coach once said there, you can't teach height. So I think temperament is the height of investing. You can tell, but what you can do is you can learn about your temperament and put in safeguards. Again, so one thing I suggest is to people is, so my friend who sends me these panic texts, which by the way, interestingly enough, the other half of the time he sends me texts like, I'm up 10% over the benchmark. Look at me, right? So I probably shouldn't do that with a microphone. But so seriously, right? So he's like almost like manic in the sense like he goes from like he's super happy, he's the Warren Buffett, the new version of Warren Buffett, to oh my God, I'm gonna get fired. What am I gonna do? How did I? So meditation is one. And the reason meditation is one, so what meditation is, it focuses, so when you do like whatever, mindfulness meditation is you focusing on tuning out things. And inevitably you'll fail. And people think they're failing at meditating, but they're not. The whole point is you get distracted and then you bring your mind back to the breath or whatever it is you're doing. So it's like your mental muscle is getting a repetition of something caused me to act differently and I know I should, bring back to what I should be doing. Okay, another distraction, bring back. So I think that's something you can do. And what I believe in, what works for me, and of course, as we know, everyone's above average, and I have a way above average temperament. So, but I actually do believe in, jokes aside, I do pride myself on my temperament. But even with that in mind, I still put checks and balances, such as I have a very detailed written process, and I communicate it to all my investors and potential investors, partly to explain, but partly to tie myself to the mast, right? The Odysseus, like the siren song. So you're going to be tempted to do something, so you're going to try to prevent you. So not only do I tell them what I should be doing, and then every letter, every quarter, I explain what I'm actually doing versus the process. So if I ever have a crazy thought of, I just want to gamble on this far out of my stock option that's going to go 10x or 0, because if it goes 10x, it'll be really good. Not that I get those thoughts, but if I were to get those thoughts, the next thought would be, I have to explain that. And I have to explain how does that fit with my process. So I think tying yourself to the mast of process, assuming your process is good. And even if you're an individual investor, you can communicate, like, if you're married to your spouse, whatever. So it doesn't have to be, if you're, an institution, it can be to your board. So there should be some oversight. I think that's pretty effective. So I think you train yourself to be better at, calming down, refocusing on what's important. You have a process to come back to, so you know what true north is, and now it's a matter of bringing it back to true north. And then you create external accountability. So get someone to check, and force yourself to be checked periodically so that you can cheat against that. And I think it's still imperfect, but I think those are the best ways I've found.
Or just get a bigger desk.
Bigger desk, so you can a tent. You can get a crying tent, That's right. Other questions? Yeah.
When you lost the 75 million, what would you have done
Thanks.
differently?
I was trying to forget that. I just brought it there.
What would you have done differently in that respect?
Bless you. I think part of it is I think I didn't focus on quality enough early in my career. I was much more quantitative, not in terms of using computers, but in terms of multiplying numbers together, saying, the stock is going to earn $1 and it should be worth 15 times earnings or whatever, right? And my value is 15, and I wasn't very, and I think that's one of the things that comes with experience. Is one time, Joel, who was one of my mentors there, that's you. He basically on my desk left my recommendations, and Fidelity 1 was a strong buy, 5 was a strong sell, 3 was a hold. And then a return on equity. So return on equity is, for those who don't know, it's a measure of quality of the business. So higher is better. And he left just with my tickers, return on equities, recommendations. And I clearly saw they were in inverse order. And I ran into his office and said, well, what do you mean, Joel? But we're supposed to be value investors. It's not just the quality of the business. It's how undervalued is it versus intrinsic value that matters. And he kind of shrugged and went back to his 10K. He's not a very, talkative person. But the point was made that, it's thinking about, the quality of the business is super important. And I think I didn't think in that case about the quality of the business, enough. I kind of fell. The other thing I think I did wrong was I took management's spiel at face value and their projections, and rather than doing my own thinking, it was they kind of spoon-fed me these stories, which weren't lies. But management is naturally over-optimistic. Just like we all like to believe the best about ourselves or what we're working on. This was a smart man. He went to HBS and he went and he's like all this stuff. And unfortunately, he did not succeed at what he was doing. But I did not think independently enough at that time. I think so. Those were the two things. Interestingly enough, another company, just to show how important qualitative judgment is. So I had the same idea. Another company in the space where I thought was worth over $40, and the theory was underpinned by the fact that I thought, on average, over an economic cycle, they should earn $2.50. And 10 years later, I look back, and I wasn't following the industry anymore, just out of curiosity, and I thought that would be off, of course, and they earned 25 cents on average. That's humbling, right? So because we all think that we're going to be more precise. So if you're estimating someone's going to earn $1 on average for a long time, you think, well, if I'm wrong, it's going to be 90 cents or 80 cents. No, right? But how much you can be wrong varies. And that's why I think one of the reasons quality is so important is that you can be way, 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 way off on the really tough businesses. Because they can completely get wiped out. In this case, what happened is oil prices went up drastically, and that was a key input for that company. And because it was a bad business, it didn't have the pricing power to pass that through. Now, if it were a good business, maybe the margins would have compressed in the short term, but it would have been able to raise prices to offset that. And where do you put that? How do you multiply that by something? That's not something you can multiply or put into a formula, but nonetheless it's critical. And I think understanding that qualitative characteristics of businesses are just as important, if not more important, has really helped me evolve over time. But it's still a painful experience. I still viscerally remember. It really is like getting sucked, because you just don't expect it. You come in, it's like the year's almost over. I was already thinking about how I'm going to spend my bonus, and then you come in, it's like, no, this is a typo, it's some kind of a market mistake. The computer broke down. It's like, no, the stock is down 50%. It's when there's this, it was trading here, and there's nothing in between. It's kind of like it jumped over there, and it continued. So anyway, but by the way, you learn. I think you're all going to have failures in life and in your profession. I think the choice you have is, are you going to have a learning mindset to the earlier point and learn the lessons and use that as a kind of motivation for improvement, or are you going to use it as a motivation to wallow and kind of defeat and self-pity and oh, what was me? So I think having that, hey, I made a mistake, there was a consequence, let's accept the consequence, now let's make the best decisions next time, this time, and learn, improve our process, that's how you're going to win over long term. Yeah?
How long will you hold a stock, and why? And how long does it take you to know if you are right or wrong on a stock?
Yeah, so I think my average holding period in my old fund, I don't have enough data on my current portfolio because I've only been doing it for 2.5 years in the current structure. On the old fund, the average holding period was 4 years. And by the way, there are funds that have a 20-year average holding period. Now, I tend to think that that's not optimal. And also, by the way, I don't target the holding period. I basically, if tomorrow someone offers me full value for all my stocks, I will sell them all. So sometimes people associate a long-term time horizon with a buy and hold approach. Buy and hold, and sometimes people think that Warren Buffett preaches a buy and hold approach, and it's not. I don't think it's true at all. The buy and hold approach essentially says that you're going to own something irrespective of the relation between price and value. So you're going to buy it. Let's say usually it's referred to some kind of high-quality blue chip company. It used to be IBM or Polaroid, or maybe it was GE. And right? So someone buys the blue chip to perceived, one decision stocks. They used to be called in the 60s in the Nifty 50, and you hold them forever. It's such a good business. Price doesn't matter. You just hold it. Well, so then you have to ask yourself, are the U.S. capital markets that inefficient that this company that's very well known, followed by a lot of people, is mispriced for decades? Because if it's not mispriced, that means that you're getting kind of the market rate of return by holding it. And so you're not doing yourself any favors. You can just own an index fund. So if you're holding it, you're implicitly saying to yourself you expect a higher rate of return by owning this asset than the alternative assets you could own. So I don't believe that these super long periods of time make sense if you're comparing price and value. Because implicit in that is that you have such glaring inefficiency that the gap just doesn't close. And then the capital markets wouldn't work. Because remember, the purpose of capital markets isn't to buy and sell stocks. The purpose of capital markets is for companies to raise financing for real projects, right? So they bring in IPOs or they bring in secondary offerings and they raise capital and then they'll build a plant. That is how it works. This is a side, investing in the secondary market is a sideshow, but it's an important sideshow because it keeps the prices roughly correct, because then these companies can raise capital at roughly fair prices. And if prices were out of whack for decades at a time, they wouldn't work. Now, there are times when a stock can be mispriced for such a long time, and usually it's called a compounder. So the answer to your question, there's not a fixed holding period. So let's say you take a company and there's no growth, they have no reinvestment opportunities, so they can't put capital back into the business and new projects at attractive rates. And you're buying it because you think that on average it's going to generate $1 of free cash flow per year, and it's trading at $5. So you're getting a 20% return, $1 into 5, and you buy it. That sounds like a pretty good return. Well, let's say tomorrow the stock goes to 10, and let's say 10% is what you think is the minimum you should accept. You're done. Now the stock is offering you 1 into 10% return. You made 100%. You should move on. Now it's very different from a company that's today earning $1, but it's able to reinvest that dollar back into the business at very high incremental returns on capital or returns on equity, because that's called a compounding machine. So that's basically you take $1 and then let's say you get 20% return on that dollar, so that becomes $1.20, and then the $1.20 becomes $1.44, and so it keeps compounding. And the market maybe doesn't fully appreciate the magnitude of that compounding. So those are the rare exceptional stocks where you could potentially, like Charlie Munger is known for looking for those, like Costco is an example, where they have good reinvestment opportunities, they can compound capital at such high rates that the market price never quite catches up until the opportunity is exhausted. But that's rare. And I think when people do buy and hold, they're not finding, and these are usually smaller companies, by the way, these are usually not the mega cap companies that you're thinking of. But usually people apply buy and hold incorrectly because they heard it's good or they heard Buffett says it. What's good is to be rational and to behave as a business owner and compare various opportunity costs to the rate of return and say, how do I get the best rate of return adjusted for risk? Does that answer your question?
Yes, thank you.
Sure. Other questions? I think, all right, well, why don't I pause here? I think Patrick has much more interesting stuff for you in store after this. You know where to find me, and you know or you will know or should know how to apply for the seminar. Patrick does all the deciding. I'm just an innocent bystander. Sorry, Patrick. But thank you very much for having me. Really appreciate it. I'm going to make sure I don't walk away with your microphone.
Can you also just let everybody know where they can apply if they haven't already?
Yeah, so if you're interested in applying